Hi, I'm Larry Rascio, head of U.S. fixed income trading and portfolio management here at Olden Lane. And I'm just going to talk freely about the markets and why we're here, how we got here, and what I see is going down the pike. Early in the month, we saw a massive sell off in rates. Rates rose, and we came to learn that a lot of that rate rise was due to Silicon Valley Bank unwinding their available for sale portfolio. Banks are being forced to unwind their available for sale portfolios because they had been buying very low coupon assets 2022, 2021, as the Fed kept rates near zero. Exacerbating that was when the Fed said inflation is transitory, leading these portfolios to say, okay, I think I'm safe holding these low coupon assets. When the Fed starts raising rates rapidly in an unprecedented fashion like we saw, those available for sale portfolios start to get underwater pretty quick. Now, when available for sale portfolios go underwater, that is a direct line that hits their equity directly, as opposed to held to maturity. So, what we saw in the case of Silicon Valley Bank was the rapid rise in interest rates caused a massive negative mark to market in their available for sale portfolio, forcing them to liquidate. That kept pushing the market towards higher and higher yields. Finally, when the market realized what was going on and that it was a potential bank crisis, rates rallied sharply. Rates started to come back. We saw unprecedented moves in the front end of the yield curve, for instance. So we get a lot of questions of from clients, is how we can hedge ourselves in this environment. To me, the simplest way to hedge yourself is to remain nimble. That is, when rates rally due to a flight to quality, portfolios that are in good shape should use that opportunity to unwind some of their assets, reduce their losses. So if you're forced to liquidate your available for sale portfolio when rates are high, you take a dramatic hit. But as rates rally, some of those assets obviously come back to being profitable. And that's the opportunity I think portfolios should use. That's what I would use as a trader. Use opportunities to unwind your portfolio or reduce the holdings in your available for sale portfolios opportunistically. A lot of the portfolios we're seeing have endured pain because of their heavy concentration in mortgage-backed securities. But it's important to note that the move from, let's use an example, 2% to 3% or 2% to 4% has a much more dramatic effect on your mortgage holdings than a move from 6 to 8%, because the prepayment speeds start to flatten out. Again, opportunistic hedging, I think, is the way to survive this market. The banking crisis, if you want to call it a crisis, isn't over. I think the Fed and the FDIC quelled concerns for a little while, but now they just turned into a slow motion train wreck. I think by end of the summer, early fall, you're going to start to see this rear its ugly head. Just like in 2008, after Bear Stearns blew up, there was a relative calm in the market until Lehman Brothers went under, and that was a 6-month calm. Do I think it's going to be as dramatic as 2008? I'm not sure, but it has the potential to be. Another interesting dynamic is the Fed had been reducing their balance sheet as a way to stem inflation. They've raised rates rapidly, and all that was in an effort to quell inflation. But what they've done is, by guaranteeing these FDIC deposits, they've actually increased the size of the balance sheet, their BTFP program. So it's impossible for the Fed to fight inflation by reducing their balance sheet and increase the size of their balance sheet and still fight inflation. So inflation is going to rear its ugly head. I do not like owning assets in the back end of the yield curve. 20s on out, wouldn't touch them here. Does hedging make sense here? Hedging always makes sense. It's a question of how you hedge yourself. I'll go back to what I said originally. The best hedge is often to get out of the asset that you own. In this case, I would use opportunistically rallies in rates to systematically unwind the holdings in my AFS portfolio.